But the concept we have to introduce with this chapter is the concept of journaling. In accounting, we call it, when we keep track of our transactions, a journal. Okay. And the way journaling is done in accounting, this system was invented, like seriously, it was invented by an Italian monk in like 460 AD and hasn't really changed since. And so people are like, why do I need to buy a new textbook if this thing's the exact same for the last, what, 1500 years or whatever? And it's really true. So even now when you use computers to do accounting, it still uses the same system. And it's called a dual entry accounting system. And we use the terms debits and credits. Okay, so this is sort of like a little language of accounting you have to get used to. So I'm just showing you what's called a T account right now. And the T account is how we find the balance of a given account. So this happens to be the T account for the cash account. What type of account is cash? It's an asset. You guys are so smart. So asset account. And so here's what we have to learn. Every account has a debit side and a credit side. The term debit and credits do not have any meaning other than the left and the right. The debit side is always the left side. The credit side is always the right side. If you start to assign it other meaning, like saying, well, debit is good because that means money goes into my bank account. That's how everybody thinks because they have a, you know, I mean, sorry, debit is bad because that's money going out of my bank account, and credit is good because it means money going in. It will confuse you because different types of accounts increase or decrease on different sides. Okay, so this is what makes this whole part confusing. Okay, so cash or asset accounts, they always increase with a debit and decrease with a credit. So to find the balance of an account, each time I have a gain to cash, I'm going to debit the cash account. And each time I pay out cash, I'm going to credit the cash account. And at the end of the period, I'll add them all up. And then what you do is you add up both sides. You see which side is bigger. And you subtract the smaller side from it, and you're left over with the balance. We would say this cash account has a debit balance of $5,900. Which means that the cash account is a positive $5,900. Okay, so this just takes getting used to in practice. So the sheet I just gave you is a summary of the debit and credit rules. Okay, so you can see up there in the top corner, assets increase with a debit, decrease with a credit. Liabilities and stockholders' equity, or this, I think this one calls them owner's equity, but it's the same thing. Okay, they're the opposite. They increase with a debit, I'm sorry, they increase with a credit and they decrease with a debit. And there's a why behind it. And the short why is because that's how it all works together nicely. But in time, you'll be able to see, okay, every asset transaction involves, so if an asset goes up, then really the only other thing that can happen is another asset going down, like I paid for furniture with cash. Right, that'd be one asset going up, the other one going down. Or if my asset's going up, then my stockholders' equity could be going up because I generated revenue. Or my liability could be going up. So because I borrowed money. Okay, I mean, that's really all that can happen. And so we call this dual entry accounting because every time there's a debit somewhere, there's a credit somewhere. And they always equal each other out. So each time we have a transaction, there'll be two entries. Okay, I'm getting ahead of myself a little, but I just want to kind of introduce you to the idea of that. All right. So like I said, I'm just going to skip past that and get to these. So we've talked about the concept already, but I just want to review it before we jump into all the other stuff. Assets are resources owned by a company. And I wanted to give you this because it has a nice long list of potential assets you might see. We're pretty comfortable with cash. We know what that is, right? Usually it just means your checking account, honestly. Supplies, accounts receivable, that means money owed to you. Buildings, equipment, we're pretty comfortable with those, but these two, intangible assets and prepaid expenses, are a little weirder. So the first one, intangible assets, means assets that you don't, that aren't like physical things. So it's often like patent rights, right? Do you guys know what a patent is? if I research something and then I come up with something that is kind of new enough, different from what everybody else has out there, I can apply to the government for a patent, and the patent protects my legal right to earn profits from that thing I created. And so it certainly has value. You can even sell a patent, right? I can say, hey, I've developed this, but I'm not a marketer. I'll sell it to you for a certain amount. So those are what intangible assets are. Copyrights, right? The Nike swoosh is a copyrighted symbol that Nike paid some firm about $1 million to develop for them. I think they got their money's worth out of it, right? But it has value. You see a Nike swoosh on something, you make assumptions about it based on what Nike's brand means to you. So that's an intangible asset. And then prepaid expenses are a little bit weirder. So this would be like when I pay for something in advance. Let's say I pay my landlord for 6 months rent. How do I record that? My cash would have gone down by a full 6 months worth of rent for cash, but the value I'm going to get from that rent is stretched out over the next 6 months. So what we do is anytime we prepay for something, we record it as an asset called a prepaid expense. And so this might be called prepaid rent. And so my cash would go down and my prepaid rent would go up. And then each month when I get charged my rent, I reduce that prepaid rent and then claim my rent expense for that month. That way my books aren't weird because I've got 6 months worth of rent expense all at once and then nothing for 6 months. So just a prepaid asset is just paying, or I'm sorry, sometimes they're called prepaid assets. So prepaid expense is just paying for expense out into the future. It's really normal. That's why, like I said, I ran a storage business for years. Really normal for people to say, okay, if that's only 50 a month, can I just pay you 600 for a year and not have to deal with it, right? And so how do I record that on my books? You know, I get all this money, but I haven't really earned it yet. So that's prepaid liabilities, debts owed, accounts payable, notes payable, wages payable, unearned revenue. So again, accounts payable just means money I owe to my suppliers. Usually when they say, hey, don't pay me, you know, you have 30 days to pay me, you don't have to pay me today. Notes payable is more formal. It's where we draw up an agreement that says you will pay me this much and you'll pay me interest, and it has, so it's a more formal version, right? Like if you borrow money from a bank. Wages payable would be when your employees earn money, but haven't yet been paid, which happens every time between the day they work and payday, right? So you have a wages payable at any given moment. And then the weird one here is unearned revenues. This is kind of the opposite of that prepaid expense. So this is like now me as the business, my customer gives me a year's worth of pay. How do I record that, right? So I show my cash going up, but I can't record it all as revenue today. So instead what I do is record it as a liability called unearned revenue, which means I either owe the customer their money back or I owe them the service I promised them. Then each month, as I earn some of that, I record it as a revenue and reduce the liability. So, and that's something that will become easier as you work with it. Stockholders' equity, we've already learned about common stock and retained earnings. And then dividends are money we pay out to the stockholders. Okay. We've also learned about revenues. That's money that you earn by doing business. They usually get listed as something like this: fees earned, fares earned, commission revenue, rent revenue. So usually you'll see either earned or revenue in their name. Those are keywords to help you think, oh, this is a revenue. The only one that will confuse you is the one called unearned revenue that I just showed you, because that's a liability. So you have to just remember that exception. Same with anything that says payable is a liability. Anything that says receivable, that's an asset. So those are key terms that as you kind of cue into them, it'll make this sort of language of accounting a little bit easier. Finally, expenses, they almost all have expense in their name. So that's nice. So you can usually figure that out, but that's just money you pay out as part of operating a business. Like I mentioned, all transactions that we're going to deal with are what's called a double entry system, which means there's always going to be a debit and always going to be a credit to every transaction, and they have to equal each other. Now we can have more than one debit, right? We could debit 2 accounts and credit a third account, and then they still have to balance. So don't let that trick you into thinking there's only 2 entries, because sometimes there's more, but there's always going to be debit and a credit, and the debits and credits will equal each other. Yeah. Did you have your question? Oh, I thought you were just rubbing your hands, like planning ways to take over the world or something like that. I do that all the time. Except for when it's soccer season, like then my whole ambitions from taking over the world just narrow down to like, how am I going to win this next game? And then soccer season's over and I got to take over the world again. So, or maybe the tri-state area, right? All right. So our balance sheet accounts, we call assets, liabilities, and stockholder equity our balance sheet accounts. Why? Because they're summarized on the balance sheet. Does that make sense? That's just a name we give them. So you'll notice that our assets increase with a debit, decrease with a credit, and our liabilities and equity are the opposite, okay? This helps me memorize it because this is just something you kind of have to memorize, okay, these rules. Because I know what assets are, and I recognize that because assets equal liabilities plus stockholders' equity, like they're on opposite sides of the equal sign, that they're opposite from each other. For my brain, that works. So if I know assets increase with a debit and decrease with a credit, then I know that liability and stockholders' equity are the opposite, and I have all three of them memorized. That's how my brain grabs onto it. There's actually in Canvas, if you go to additional study resources, there's a couple of videos from the internet that several students have told me really helped them lock down and remember these things. A couple different strategies that people have put out there. This is so hard. If you just Google it, or I mean, go to YouTube and search it, there's a lot of people have made videos about how they memorize these things, even though it's not really that hard. But in the beginning, it feels super hard, like anything new, right? Then we have our income statement accounts, revenue and expenses. They're called income statement accounts because the income statement summarizes revenues and expenses. And revenues increase with a debit, decrease with a debit and increase with a credit, and expenses are the opposite. So they increase with a debit and decrease with a credit. Again, why? Because this is what makes it all work together. When you guys get a little deeper in, maybe we'll take a moment and stop and say, now you can see why. But right now it's best to just sort of learn that this is how it works and work with it. Does that make any sense? Like, have you ever had someone try to explain a card game to you? And you're just like, you just gave me a bunch of rules and I don't know. But then you play a couple hands and you're like, oh, okay. And then if they explain the rules to you, you'd be like, oh, and then you could ask clarifying questions. So I really think it's the same way, is learn the rules, start working with it, and then and then your brain starts to open up to like, this is why this all flows together. Dividends, they behave just like expenses. So they increase with a debit, decrease with a credit. They're given their own little page. I bet they feel special. All right, one more concept, and you'll see it on that little cheat sheet I gave you. I call it a cheat sheet, but you won't be allowed to use it on the exam. So what I would say is use it with your homework and then as you get more comfortable, try to do debits and credits without the reference sheet, right? Maybe we'll call it a reference sheet. That's just a nicer term. Precision of language, right? So we have the normal balance, and you'll see, if you look on your paper I gave you, that the normal balance is always on the side that increases the account. So asset accounts have a normal balance on the debit side. Expense accounts have the normal balance on the debit side. Dividend accounts have a normal balance on the debit side. Liability accounts, stockholder equity accounts, revenue accounts, they have a normal balance on the credit side. So the normal balance really just means, if I were to look at an account, what would I expect its balance to be? And the answer is I would expect it to be positive, because we don't actually have, it's weird, like how do you have negative cash? I mean, especially when you're accounting for liabilities separately, right? You would just have a positive liability and a zero cash or something like that. So the normal balance is always the side of the account that is the side where it increases. Why? Because we would expect, it would be normal for the account to have a positive balance, okay? I know I'm throwing a bunch of terms at you without a lot of context. So we're going to get into some context now. So what happens in a real business, computers do a lot of this now, okay? But each time we have a transaction, we journal. It's called Journalize it. We put it in the journal, okay? And so a journal is a chronological list of transactions. Each time a transaction happens, we record it, okay? So each time when you go to Walmart and you scan something across the scanner, that computer is recording that transaction in a journal, okay? So that's happening just faster than a person could do it, okay? So here's the process by which we journalize. First, we date the transaction. That's easy. That doesn't mean you take it out for a nice dinner, right? It means you write the date, okay? Second, I mean, you could take it out. I saw a news story about a lady in Belgium who has decided that she is in love and he's in love with her with a male chimpanzee at the Brussels Zoo. And she goes and visits him every week. And what they have is special. And it's caused this chimpanzee to like stop hanging out with the other chimpanzees and seek more human contact. And so they've banned her from the zoo because it's hurting his development. And I just thought, it's a strange world we live in. I mean, chimps they're moderately attractive, but I just thought it was a weird story. And you're like, we have all this crazy stuff going on in the world, and then I'm like, this is the news I choose to click on. And then like my Apple News, if you ever look at what it shows you, well, that's based on what you click on, guys. So, all right. So date the transaction, not the chimpanzee. All right, step 2, title of the account to be debited is recorded, and then the amount to be debited is entered in the debit column. 3, the title of the account to be credited, blah, 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 blah. Okay, so this is their process. My process, sometimes you do a brief description and then a posting reference. My process is like, I'm gonna look at it and I'm gonna analyze it. I'm gonna say what accounts are impacted, which one's going up, are they both going up, which one's going down, right? And then say, what type of accounts are they? Okay, that's an asset going up, so that's gonna be my debit. So that's the process I go through each time I have to deal with one, is sort of like talking myself through what accounts, how are they being impacted, and then review that up against the debit credit rules so I can make my entry. Okay, so let's just do some examples. So I got a bunch of example slides, and I'm sorry for that, but I think that's the best way. We're gonna walk through. So November 1st, Chris Clark, kind of a dope name, deposited $25,000 in a bank account in the name of Net Solutions in exchange for common stock. So for my brain, so here's all their steps, right? Step 1, put the date. Step 2, the account to be debited. But you're like, to me, I've got to be like between the date and step 2, I've got to actually think about what's debited and what's credited. So my process, all right, I have cash. He's putting money in the bank account of the business. So the cash will be going up and the common stock account will be going up. Cash is an asset account. Assets increase with a debit. Common stock is a stockholder's equity account. They increase with a credit. Now I know my entry, okay? So I'm gonna debit cash. And so the debit is always listed first. And then you'll see over here on the debit credit side, debit's on the left, credit's always on the right. Again, remember the terms debit and credit don't mean anything other than left or right. They don't mean anything else. We get this banking idea with debit cards and credits, but you know, so it's the same as like port and starboard, right? You know, on a boat, right? Like that's all it means. Actually, port and starboard are slightly different than left or right because port means left in relation to the front of the boat, right? Not just left anywhere on the boat, but maybe you didn't want to know that. All right, fore and aft. Okay, that's it. Then there's the mizzen part. Okay. So we're going to debit cash, $25,000, and then we're going to credit common stock, $25,000. And then after we do a journal entry, what we do is we record it in what's called a ledger. This ledger is set up as what's called a T account because this thing looks like a T. And we use that so that over time, we can see what the balance in any account is. Again, most of this is done by computers. Recognize that if some of you decide, oh, I'm gonna go on and be an accountant someday, that this isn't like, you don't do all this by hand. You put your transactions in a computer, it does all this work for you. But the reason you have to learn it when you're starting out is you have to understand the whole process. At the college, we have a bunch of people with the term accountant. Most of them are just data entry people. They're doing a lot of computer work, but our controller, who's our senior accountant, he has to understand how all the processes come together, because when we get audited, guess who the auditors say, show me this transaction and where it came from, right? And so, and the difference in salary between the level 1 accountants is they make 35 grand a year and the controller makes 130 grand a year, right? So this is why you have to learn all the little stuff underneath. Anybody have parents that are CPAs? Because every semester I get 1 or 2 CPA parents and they'll be like, why are you learning this? Computers do all this crap. You don't have to know this stuff. well, they forget that they had to learn their times tables before they could do advanced math, and they had to learn to ride a bike with training wheels before they could ride it with none, right? So on November 5th, they pay $20,000 for the purchase of land as a future building site. So again, I'm going to say, okay, what do I have going on here? I have land going up. I have cash going down. Land is an asset, so it's going to increase with a debit. Cash is an asset, so it's going to decrease with a credit. So now I can make my entry. I debit land, $20,000, and I credit cash, $20,000. That's what the journal entry will look like. We purchase supplies on account for $1,350. So supplies is an asset. It will increase with a debit. And then accounts payable. What type of account is accounts payable? It's a liability account, and it's increasing. And so it will increase with a credit because that's the rules, right? Again, don't be afraid to use this reference sheet until you get more comfortable. This is new stuff to you, so it's going to be a little hard at first. I don't know where this idea comes from that I'm going to jump into something brand new and it's not going to be hard at first, right? Like anything you've ever done that had any value was difficult in the beginning. And if any of you play a musical instrument, you remember the hours of your mom making you do piano or violin or whatever it was that you were doing. And you're like, I hate you for this, mother. And now that you can play, you're like, okay, I get it. Still hate you though. I mean, but those are other issues. Okay. Maybe, I hope you guys don't hate your mom. Even if your mom's annoying, remember she loves you, and she's usually being annoying because she's worried about you, not because she, you know, I mean, don't get me wrong, there are some like really abusive or hardcore like moms out there, but most of our moms are just annoying. My mom, never annoying, always perfect. All right. Let's see. So we received cash of $7,500 from customers for services provided. So cash is going up. Cash is an asset, so that's going to go up with a debit. And then fees earned, was the term they're using here, is a revenue, and revenues increase with a credit. So my journal entry will be debit cash, credit fees earned. Just so you know, I mean, I see you taking pictures, and that's okay. But also, if you want a video of this lecture that I'm recording right now, so I'm wearing this earpiece, will be up on Canvas in the next couple days. In fact, what I've been doing is breaking them into like chunks for each section and then having the whole video uncut. So all of that's available. Also, the full PowerPoint deck that the publisher puts out is available in their additional materials in there. I forget what I call it on there, but it's like textbook additional stuff or whatever. So that's there if you want it. So there's a lot of resources there. But remember, I've trimmed this down to 35 slides from there, like 90. Okay, on October 30th, they incur the following expenses: wages of $21.25, rent $800, utilities of $450, miscellaneous of $275. So all expenses are always increased with a debit. So I'm going to list all my expenses. So here you can see we have a bunch of entries: wage expense, rent expense, utility expense, miscellaneous expense, and then since we're paying it in cash, and cash is an asset, it'll be going down, we'll credit cash. And again, so even though there's more than one entry, this is still dual entry in the sense that our debits and our credits will equal each other. There's always an equal amount of debits and credits in any given transaction, every time. If they don't balance, then you got a problem, and it's something you can solve at that level, the lowest level, instead of way later when you're trying to make your balance sheet and it doesn't balance, right? So I try to check each one. Most computerized systems, if you're not in balance, when you go to hit enter, it's like, whoa, wait a minute, something's not right here, right? All right, they paid creditors on account $950. So I'm going to have my liability, accounts payable, will be going down. Liabilities decrease with a debit. And my cash, which is an asset, going down, and assets decrease with a credit. So that'll be my journal entry. And I'm kind of just going through it a little faster now because I feel like you guys are starting to get the concept. And probably what you need next is practice at it more than more talking about it, right? Net Solutions purchases $1,350 they purchased $1,350 in supplies on November 10th. Chris Clark determined that the cost of supplies on hand at November 30th was $550, Thus, $800 of the supplies must have been used during November. Are these transactions sounding familiar? Right, they're the same ones we did when we were just showing how they affected the accounting equation in the last chapter. So they figured out how many supplies they used. They debit supplies expense, credit supplies, because supplies expense is an expense and it increases with a debit. Supplies is an asset and it's going down. So that's a credit. There we go. There's ours. And then H, we paid dividends of $2,000. Dividends increase with a debit. Cash decreases with a credit. Oh my goodness, how many are there? All right. So let's see. I think these are a bunch of extra transactions that I had in there in case we needed them. I'm going to skip past them because there's been plenty. Oh, actually, I want to get down to these. All right. So this is what we would call our general ledger. I mentioned to you that sometimes, so that when we record things in our journal, we show the debit and the credit, the two accounts, and it's chronological. Each time a transaction occurs, we record it. But then we have to transfer over our journal entries to what's called a ledger. And a ledger is what allows us to keep a balance for each account. There's kind of two different styles of doing ledgers. The first one I already showed you an example of, and that's the T account. So the T account is like a really simple ledger. It has the name of the account up here. So we'll look at like cash. And then each time I debit the account, I do the amount. So that first transaction was a debit of 25,000. The second transaction was a credit of 20,000. And so forth. Each time I have a transaction, I just record it on that T account. A more fancy way, I don't know what you want to call it, is a ledger that shows not just the T account. If you think about it, these would be the parts that go on the T account, but it keeps a running balance too. When you do a T account, what you do is at the end of the month or whenever you're done, you just total it out and say, okay, what's the balance? Is it a debit balance or a credit balance? Here, what we do is we keep a running balance. So it has the date. It has, don't worry about post references that much. Okay, but it has whether there was a debit or a credit, and then it has the balance. So you can see when they debited 25,000, the new balance became 25,000. Then they credited 20,000, so the new balance of the account is a debit of 5,000. Does that make sense? So the balance of the account is just the difference between the debits and the credits at any given time. And then it goes, so you'll never have a negative number in any of this. You'll either have a debit balance or a credit balance. So if we were going to have negative cash somehow, which we wouldn't, but if we did, you just have a credit balance to the cash account. Okay. So you can see this is our cash account and all of those transactions. And in the end, we end up with a balance. In this case, a debit balance of $2,065. Our accounts receivable, again, the first transaction was a debit of $1,750. Then someone must have paid us $650. Then, and then another $1,120. And so the balance just updates each time. This is one of those things that once you do it a few times, you're like, this is incredibly easy, right? Each time I do an entry, I put it over to the journal so that I can know the balance. In the old days, and the reason these are called books, okay, in the olden days before me, what you had in essence was you had this book that was split into sections, and the first section was the journal. And so you'd record your transactions each time they happened in the journal. And then there were like these tab sections at the back, each with a ledger page. So if I recorded this transaction of cash and common stock, I'd record the journal, then I'd turn the tab to the cash page and record this date, cash increased by 25,000 was debited, here's the balance of cash. Then I'd flip to the common stock page and I would record this date, and I'd credit it. And so it was all there in the books, right? And so now, as you can imagine, computers make that so much easier. In essence, all I have to do is hit the one entry and it posts it straight to the ledger for me. Thanks, QuickBooks, or whatever software you're using. These are all just the other general ledger accounts. I don't want to explain them. They're just all there for us. All right. So once we have, so we get to the end of the period, we have balances in those ledgers for each of our accounts. We can summarize those balances on a document called a trial balance. Okay. So the trial balance has all of the accounts listed, any account that has a balance on it, and then its balance, either a debit balance or a credit balance. So again, if you have to create one of these and you already have a ledger, it's not hard. All you're doing is taking the balance from the ledger and saying cash has a balance of 2,065 on the debit side, and so forth. So this is a trial balance. I want you to think about the fact that if I have a trial balance, at that point, it's super easy for me to create my financial statements, right? A balance sheet, which summarizes assets, liabilities, and equity. Well, I've got all my assets together. And then my liabilities, and then my stockholders' equity accounts, all in one place with their balances. So in the old days, again, what accountants would do is they'd get to the end of the period, they'd summarize all of those balances in a trial balance, and then they'd prepare the financial statements just based off of that. Now, again, in the computer, I can just say, reports, give me an income statement, give me a balance sheet, and it'll spit that out for me. So they're always in this order, okay? Assets listed first, followed by liabilities, followed by stockholders' equity, then the dividends account, then revenues, then expenses. Always in that. And if you think about that, I call that financial statement order. Okay, we have our balance sheet accounts all together. Dividends are on that statement of retained earnings or retained earnings summary that we learned about, and then revenue and expenses are on the income statement. Okay, so they're always in that order. I don't know if it tells you that anywhere, if that's like some unwritten rule you're just supposed to pick up on, but that's how they're always done. All right, one last concept. They kind of tag these concepts on the end of these chapters. But the concept is last time we learned one of the ratios, right? It was like liabilities to total to equity or something like that. I forget what ratio that we learned in the first chapter. So this is a concept of something called horizontal analysis. So recognize that horizontal means this way, right? You always remember that because you know what the horizon is outside, and you're like, it goes this way, as opposed to vertical, because, you know, I remember because in Chinese, the word for helicopter is 直升飞机, which means vertically ascending aircraft. So then I know, so that's how my brain remembers it. I don't know, but anyway, so horizontal analysis means across. And so this means we're going to compare the amount of each item on a current financial statement with an item on an earlier statement. So when we talk about horizontal analysis, when it comes up in your homework and other areas, what we mean is we'll take 2 years income statements, for example, or you can do it with balance sheets, and lay them out next to each other. So all the items are next to each other. And then we can look at the amount of increase or decrease between the years. It's just a way of analyzing, right? To say, okay, well, our revenue went up by 37,500 and our net income went up by 15,800. And then you could say, well, why is that? Why didn't it go up by the full 37.5? Well, wages went up, rent expense went up, utilities went up. The only expense that went down was supplies. So even though our revenue went up, our expenses also went up. So, you know, we made more money, but not as much as we could have. So that the reason to do that is because I was just able to, in 20 seconds, know a lot about what's going on with this company, right? So just know that this is horizontal analysis. And what it means is comparing line items from a financial statement, income statement, balance sheet, against the line items from a previous period. Sometimes you'll see 3 or 4 years laid out together. And then to do the analysis, they just do the difference or the change from year to year, and then the percentage change, okay? So you might see that come up.